If you've been keeping your eye on the news lately, you probably noticed a recurring theme: recessions. That's right, the dreaded R word is back in the headlines. But what does this mean for the global economy, for businesses, and for you? In today's video, we're going to look through 16 charts that are going to give you an edge inside financial markets. It's always important to prepare and not be scared. Let's run the numbers. Which news headline would you read? A news headline that says this: disaster, imminent disaster ahead, you must do something about it, or everything is fine. Both news articles could be actually talking about the same thing. Inside the masterclass, we look more deeply and we do analysis, and that's what we need to do. A lot of people are terrified of recessions and depressions, and of course, why wouldn't they be? The concept is price just decreases significantly and rapidly, and they are unprepared. We get around this problem by adhering to Rule 252, prepared and not scared. Getting prepared is always important. Every professional investor and trader knows that there's always shocks to the economic system. The first way to get prepared is to understand how to read charts and what charts are important to look at. With these 8 charts, there are very important charts to be aware of: the S&P 500, the Nasdaq, the Russell 2000, and the Dow. The most critical chart is the S&P 500. You can see that a blue line has been drawn across all of these charts from the 1st of April 2020 to the 3rd of October 2022. Why these dates? What you can see here is the US liquidity crisis and the pandemic hitting the global economic system and bottoming out and starting to reverse on April Fool's Day 2020. The 3rd of October date is when the S&P 500 bottomed out and started to re-rally. You can see that the 3rd of October and the 1st of April are drawn on each of these charts. This is important to understand. All charts are intercorrelated and interconnected. Newspapers, media outlets, they require drama and fear to get you to watch the content. Knowledge is, after all, pretty boring. Drama is much more interesting. So, is there drama inside the main markets? Let's look at the S&P 500. You can see we're starting to curl over, but we're above support. What about the Nasdaq? We're above support. What about the Dow? We're above support. Russell 2000? That's a little bit different. There's weakness there. What about the DAX in Germany? Germany's main exchange? It's fine. What about the Nikkei? Japan's main exchange? It's fine as well. What about the Hang Seng in China? That's been looking pretty sick, but it's been looking unwell for quite a period of time. What about the ASX 200, Australia's exchange? It's looking pretty good, literally right at a support level. Let's keep on venturing around the world. What do we see in the UK? The UK main index, not a problem, actually reaching new highs. It does start to curl over, but that's okay. What about Russia's index? Ever since Russia declared war on Ukraine, Russia's economy has suffered. But we can see even the 1st of April and the 3rd of October, they're still very important dates. What about Taiwan? Taiwan is doing well. Singapore's main market. Singapore's market was quite interesting. It exhibited quite a bit of weakness after the 1st of April. We don't typically see this in the other global indices, and we're seeing a little bit of weakness in Singapore's market, but there's a lot of consolidation through there. What about India's market? India has benefited significantly from the weakness and breaking of supply chains in China. The Indian market has been incredibly strong. Switzerland's market has been showing a lot of weakness. We can see it hasn't been rallying. It's been very subdued. France's market is looking quite good. It's got a similar kind of concept to the Indian market. Canada's market is looking weaker. This is exactly the thing that the media outlets do. As soon as things go a little bit red, they jump on a bandwagon and say everything is heading towards zero. Why? Because they need you to buy articles, they need you to read. We can see that the majority of the main markets are actually looking quite healthy. This is just a natural retracement. The other thing that we need to talk about is what is a recession? A recession is defined as 2 quarters of negative GDP growth. What we can see when we looked at the GFC, the global financial crisis, as soon as the recession was called, there was a bit of rally inside the market and then followed by a big pull down. What about this one? We can see when we go back to 2001, by the time the recession was called, it was the bottom of the market. What about this one back in 1990? Again, bottom of the market. What about this one? Back in 1981, it was close to the bottom of the market. We did have a little bit more negative price momentum, but there is always price moving in a wave. If you are a trader, you just love the volatility because it's perfect for trading. What about here? As soon as the recession was called, guess what? It was over. What about here in 1974? It was a lot like the GFC. It had a lot more negative momentum. But the question is, when you come to investing and trading, and most people invest because they're unsure how to sell, buying is not a problem, but selling is tricky. Why is that? Because the price can always go up, but it can always go down too. But the concept in here, if you bought a stock right down here around the bottom of this and just hold on for the next couple of years, you would have done incredibly well. Investors say, I'm going to dollar cost average, but as soon as the market goes red, they say, I've had enough of this market, I'm getting out, and they sell. The two ideologies don't support each other. And what about this? In 1970, what did we see? As the recession was called, the market was recovering. What about this? You can see in 1966, the market came down, there was no recession. What about here? 1962, no recession. What about here? 1960, by the time the recession was called, 2 quarters of negative GDP growth. Hey, guess what? The recession was over. What about here in 1957? Again, recession was over. What about here in 1954? You get the idea. The recession was over. The prices were going up when they said, it's official, it's a recession. Please let me know in the comments, when you hear the word recession, does it signify to you that you should sell everything and run? If you did so in the 1949 recession, guess what? As soon as they called it, the market recovered. What about this? The 1945 recession. Again, the market was rallying. What about this recession in 1937? We had more negative downside. But if you're prepared, this is no problem whatsoever. It's dollar cost averaging in motion, and that's what investors should be doing. But they don't, they run. But you might say something like this, Ken, look at this incredible sell-off. It's like that, or it's like that, or it's like that. The market is going to tank. Well, we do have a support level approximately at that 41.96 mark. So if it hits here, it's just a fantastic buy. But what if it doesn't hit there? What if it goes down? How do we actually apply Rule 252 in practice, prepared and not scared? The first thing that we must understand, there are 3 different tiers of charts. The Tier 1 charts are the engine of financial markets globally. We must understand the structural levels on Tier 1 charts. By marking up your chart with the CTKS method, and here I've marked up the S&P 500 since 1871 with the standards-based methodology of the CTKS method, we can see that we've got structural support between 42.52 and 43.14. This means that the buyers will enter the market at structural support. What about the next level down if we don't hold that particular line? There's a lot, and I mean a lot, of structural support inside the S&P 500 from 40.37 to 41.76. But what if we slice through that as well? Where is the next structural barrier? Where is the next floor? Where are the next safety nets? They're between 37.56 and 39.36. One thing to pay particular note of, if you're looking at a chart and it's not in logarithmic format, what it means is the person showing you the chart doesn't actually know what they're talking about. Now, hey, Ken, that's a little bit harsh. What are you saying that for? I've seen a lot of people just do arithmetic charts. Unfortunately, from a mathematical and statistical basis, what investors look for are percentage returns. Logarithmic scale measures percentage returns. Therefore, the percentage return above here is equal to the percentage return below here if it's an equal area, and that's incredibly important. Coming from a statistical and actuarial science background, these things really matter. It probably also helps that I did a finance degree. The reason that I'm saying this, I've been looking on YouTube recently and I've seen a lot of people do non-long charts, and when they do a non-log chart, things look absolutely crazy because you can't analyze anything in this manner. You need to have log on so that you can assess equal percentage movements. I see it all the time in exponential asset classes like Bitcoin and other cryptos. It's important to pop log on. Do not think in terms of arithmetic scale. It's just not important. Investors, professional investors, always think in terms of percentages. This is just one way. The professionals are different from retail, and unfortunately retail is emotion driven. Professionals, they use statistics, mathematics, intercorrelations and interconnections, and all that may sound really weird and too difficult to do, but it's actually quite straightforward. Oh, Ken, you're just saying that because you're a numbers guy. No, it's not the case. It's the application that you're interested in. One particularly important thing right now is to do your three-dimensional risk management. When people panic, they can drive the market down very quickly, so you want to be able to take advantage of that, not get caught up in it. Always think to yourself, what will I do if price goes against me, goes for me, or goes nowhere? The question is, do you have spare cash to put into the market at this stage? Or are you fully invested? If you're fully invested at a time like this, you'll find the markets utterly terrifying. If you have funds lying around waiting to be deployed, aka dry powder, that's completely different. You can prepare, and you won't be scared because you'll be seeking to get in to strong projects or strong stocks or strong indexes at the right time. Professional thought processes are completely different to retail. Rule 7, buying creates profits. Buying creates profits is a really fantastic rule. If you manage to buy the S&P 500 index around that 24.38 mark, you are doing really well. You can see that your profit has been protected no matter what the price is. But if you are unfortunate enough to buy the S&P 500 at around that 46.61 mark, ouch, that's really hard because you're underwater. You're underwater even though it's come back, and it's going to take time for it to get above there. But you were bought around that 36.11 mark. That's completely different. That's also a safe spot. Professionals are always looking for safe spots to buy. And they love capitulations because capitulations occur incredibly quickly. These long wicks down slurp up waiting orders, and it's always the best way to buy. But you must have a lot of patience. And also, you will require dry powder. I'm going to zoom in on this LV19 area, this particular recession band. Masterclass students, please look through LV19 again. It's really going to help you. In this chart, these are all the major economies, and you can see they're all following suit. This is really important to understand. All the markets are intercorrelated and interconnected. What is this yellow line right here, that's Bitcoin. So you can see Bitcoin is very risk averse. As the main markets sell off, everybody is scrambling for cash. They will sell everything, including dollars, including gold. A lot of people would say Rule 252 should be applied now. It should be applied every single day. Professionals always apply that rule each and every day. It doesn't matter if the market is going up or down, they are prepared. They make sure they know what they're doing with a specific trade and their entire portfolio. They are not caught off guard. They've already made their decisions and they stick to their decisions. Most importantly, they know where smart money is buying and selling. Those areas that I showed you on the S&P 500, they're where smart money buys and sells. Professionals do not guess, they know. Members of the service, please make sure that you look through the structure of your Tier 1, Tier 2 and Tier 3 charts. When you get into synchronization with the market, you will profit. But to do so requires a lot of courage and to turn your back on fear. Professionals become professional because they know that they have to have the knowledge of how financial markets work. It's not certainty, because certainty creates terror. It's about probability and about rules, and especially about percentages. Zone 1 and Zone 2 are all about fear. Zone 3 and Zone 4 are all about the mastery of fear. Fear is mastered by knowledge and processes. Professionals are aware of fear, especially how fear impacts the retail mob. And it literally is a mob. The key is to get out of this mob if you feel that you're in there and move across to the professional level. You can't make money in retail. You can only make money inside financial markets when you are professional. If you would like to become a professional, Purpuratum has very kindly offered a CTKS Partial Masterclass Scholarship. The link to apply for that partial scholarship is inside the description of this video. Thank you for watching and for being part of our global family. If you've liked the content, please smash that like button and don't forget to subscribe. Have a great weekend ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.